Hey folks, welcome back to the channel. Hope you're all doing well, although it probably hasn't been very good if you are long in the market. Looking at this past week of trading, you can see the stock market has been falling quite steeply, and the S&P 500 even went back and retested the lows back in June. I did mention before, around early September, that it looked like the market was going to fall, so whenever this happens, the most likely scenario is it's going to drop back down. But since we're at this point now, where the S&P 500 is down below 3,700, I do think in the very short term, we're likely going to see a bounce, similar to what we've seen back in June of this year. However, that doesn't mean that this is the bottom. It just means that we are testing the previous bottom, and there is a chance that if we go past below this about 3,600, that a lot of people who bought in back in June are going to get stopped out, and we are going to see likely about 3,200 for the S&P 500. But I think we'll only get that if we get continued bad news. But bad news can turn into good news for long-term investors. So in this kind of market, it's actually a really good opportunity to make long-term returns. Over the next 2 or 3 years, depending on which stocks you pick right now, it's possible to get like a 50 to 100% return. And some people will have the skills to do that, and other people won't. So, the really key factors that you'll need in order to take advantage of this recession, this stock market decline, are two things. You need to have discipline and you need to have patience. So in today's video, I'm going to share some strategies to help you with that and to give you the framework that I'm using to ride out this current volatility that we're seeing this year. Let's talk about patience first. And what I mean by that is what you'll have to realize is this abnormal activity that we've been seeing over the last year or so could continue for another 6 to 12 months. And that basically means it's really hard to time the bottom, because if you buy a stock today, there's a good chance that it will be lower at some point over the next 6 to 12 months. Stock market corrections can last 2 years or longer. So although putting your money into the stock market today will likely give you a high return 2 to 3 years from now, you have to be in the market for those 2 to 3 years in order for your gains to materialize. So that's patience. Now let's talk about discipline. And all that means is having a reasonable plan and sticking to it. So hopefully you've been keeping a list of stocks that you like and are keeping track of. So once their valuations get cheap enough, you can start buying them. So your plan might look something like this. You pick a stock from your shopping list that you think has come down enough in price for you to start buying, and then you would calculate its terminal bottom price for you. This is simply the price that you think is the lowest that the stock will reasonably go to. It doesn't mean the stock can't drop lower, but long term on a fundamental basis, that's the lowest the stock should be going. So, for example, if I were to take a look at Alphabet and don't look at the stock price, instead, what I can do is try to figure out what is the terminal bottom price that I think Alphabet can go to. So you can analyze the stock from a cash flow basis, from a price to earnings perspective, and you can also consider how fast it's growing. You can use a different number of metrics to really gauge the fair value of a company like Alphabet. And because its growth rate is fairly consistent over time, this would be one of the easier stocks to evaluate. Now, for the sake of time, I'm just going to use a very simple method, which is basically just using the PE ratio. And I look at it across time, which is about 15 years here. So the PE ratio measures how expensive a stock is because it takes the price of the stock and divided by its earnings. The lower the PE ratio is, the less expensive it is because it's trading at less of a premium compared to how much profit it's making. So looking at the data over the last 15 years, I'm going to try and find the lowest PE ratio that is shown here. And it looks like it's actually just the most recent PE ratio of 18.2. Even during the great financial crisis in 2009, you can see the average annual ratio was 21. Maybe it dropped a lot lower during that year, like in March, but eventually it came back up. So that's your average. So I can take a look at 18.2 and think, well, that seems to be pretty low already in terms of the relative valuation of Google over time. But what if I want to be a little bit more conservative? Because 18.2, if that's the annual average, then maybe this can go down to like 16 if there's peak fear in the market momentarily. So if I want to give myself like a 10 or 15% margin of safety, maybe what I'll decide is that the lowest PE ratio that I think Google can reasonably drop to is going to be 16. So then if I take 16, the PE ratio, and I multiply it by the earnings, which right now for the last 12 months is 5.38 here. This is earnings per share. And what I'll get is the terminal bottom price of what I think Google might fall to within reason. So that's about $86, meaning if we can actually get Google to fall below $86, then I would be very comfortable to hold a full position in Google. Now, full position might mean different things for different people. So if you analyze the stock and depending on the structure of your portfolio, a full position of Google shares might be like 100 shares. It might be 50 shares for you. Like if you think Google is a pretty good company and as a full position, you want Google to take up, let's say 10% of your portfolio and your portfolio is let's say $100,000, then a full position of Google shares for you would be $10,000. And because Alphabet is trading at about $100 today, we just divide that by 100. So you're looking at about 100 shares. So that's how you can determine how many shares you need to buy of a company in order to be a full position. Now, once you figure out that, you can basically just use dollar cost averaging and buy the stock a little bit at a time. So, how this might work is let's say right now Alphabet's at about $100. So, I'm going to buy 10 shares right now because $100 is still pretty far away from my terminal bottom price of 86. So, maybe I'll just buy 10 shares at $100. And if the stock continues to move down, maybe to $95, then what I'll do in this case is I will buy 20 more shares. So now I have a total of 30. And if Google continues to drop to maybe the $90 level, so this is $5 lower, then I would pick up 30 shares. So now I have 60. And finally, if Google goes all the way down to this $85 level or 86, then that's when I'm going to buy the remaining of my 40 shares for a total of 100 shares. And that is when Google reaches below $86. So basically, by the time the stock reaches the terminal bottom price, that's when you will be finished building up your full position in that company. So you're basically averaging all the way down, and each time you're buying a little bit more because the price is cheaper. And eventually, if your thesis is right and the stock recovers, then you will have much better returns than buying all 100 shares at the $100 or $99 level today. So right now, I like Alphabet. I think it's a undervalued stock. I think it's easily worth $130 today, but the markets can be very irrational at times. And another stock that I'm looking at right now that used to be sort of expensive, I thought, but over the last month, it's fallen like 15%, and that's Microsoft. So similar to Google, Microsoft has now fallen below its June lows. As usual, I don't think it's a good idea to take on a full position in a new stock, but right now is a pretty good time to start averaging in. So if your goal for a full position is 50 shares, then maybe you buy 5 shares right now. And if it goes down to like 230, you can buy another 10 shares, for example. One thing about Microsoft that's different than Alphabet is Microsoft pays a dividend. And even though it's not considered a dividend growth stock, I would almost consider it to be one. Because if we look at the dividend progress over time, it's actually been going up. On quickfs.net, this website that shows you stock information, we can see that the dividends per share has been growing over the last 10 years from just 89 cents back in 2013 all the way to 242 today. So if we look at the dividend growth rate per year, we can see that it's been pretty much double digits every single year except for 2018 and 2019, which is a very solid history of dividend growth. So although the yield is not very high, it's only yielding about 1% right now. You're getting really strong, pretty much double digit dividend growth, as well as a fast growing company that is trading at reasonable valuations. Like, I wouldn't say this is cheap right now, but you can see that Microsoft is trading at a small discount relative to the last 5 years. According to Morningstar's quant report, it's not very often that Microsoft trades below its fair value. Usually the red line pretty much tracks the same as the black line, but right now the black line, which is the price of the stock, is lower, and we see that the fair value is quite a bit above. So if I scroll down here to the price over the fair value of this Morningstar report, then we see that it is only at 0.68. And the lower this number is, the more underpriced the stock is. So at least over the last 10 years, we are at a record low. And of course, Microsoft is a large cap, one of the best blue chip companies, and it also has a really wide moat, really strong financial health, solid revenue growth, as well as earnings per share growth. So again, looking at the chart, it looks like Microsoft could go lower before it bounces. However, if you have at least a 2 to 3 year perspective, it is very likely that you can make a 30 or 40% return if you buy the stock today. Because looking at the analyst ratings, and this is pricing in a potential recession already, but Microsoft even then is still a strong buy. And if I just sort this by price target, the most bearish analyst out of 31 covering Microsoft is saying that in 12 months, Microsoft will go to 275. And even then, the most bearish analyst is telling you that you can get a 15% return if you buy the stock right now at $238. But you can see the medium price target here is $330, and that's a 38% return from today's price. So that's really the thing to keep in mind is the money you're investing now is going to give you those returns that you expect in the stock market long term. But the key is you have to wait at least 6 to 12 months over this period in order to probably see those results. So you don't want to be doing nothing because the stock market is cheap enough that you have to be a net buyer at these levels, even if it's a little bit. And of course, stay disciplined, make sure you have some kind of plan and follow through on those actions that you've set, whether it's using some kind of strategy like this or just continuing to invest the same amount into the market periodically. Anyway, I think Microsoft and Google are just a couple of companies that I think are worth looking into right now. Obviously, you'll have your own set of stocks to analyze. So good luck with your investments, and until next time.